You will fly to the perceived safety of cash and other things. But the reality is, you want safety? It's this. Because this is the only financial asset that runs no counterparty risk. All of that, including treasury bonds, that is all counterparty risk. But what's the real safety? Physical gold, physical silver in your possession. That's real safety. The other is simply perceived.
The latest Kitco News weekly gold survey sees most market analysts optimistic that gold will see a bounce in the near term, while retail investors are more evenly divided after experiencing 7 straight sessions of losses. Lynette Zang, from ITM Trading, is well regarded for her economic insights. In this video, Lynette Zang emphasizes the continued significance of gold, as 71% of central banks aim to boost their gold reserves. In the first 6 months of 2023, central banks across the world acquired an unprecedented 387 tons of gold, marking the highest first-quarter purchase of gold volume since 2000, when the World Gold Council began recording such transactions. Lynette predicts that central banks stockpile gold to protect against losses from low-interest government debt and potential financial resets. World Gold Council 2023 survey revealed that 24% of central banks intend to increase their holding reserves in the next 12 months. Furthermore, central banks' views towards the future role of the US dollar were more pessimistic than in previous surveys. By contrast, their views towards gold's future role grew more optimistic, with 62% saying that gold will have a greater share of total reserves compared to 46% last year. Furthermore, Lynette points out a worrisome trend in the CPI, indicating a continual decline in the consumer dollar's purchasing power since 2008. The US dollar has no such value today, but people have continued using it as the reserve currency of the world under the impression that it would continue having an apolitical nature. Now, we are presenting the clips of Lynette Zang's insights from a recent video with ITM Trading. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
You know, it's going to rear its ugly head again and again and again and again and again because we have such a divided and dysfunctional government. And are they really operating in your best half or in special interest best half? Think about that. Because what we know is 7 in 10 central banks surveyed believe that gold reserves will increase in the next 12 months. Yeah, let's see. If this was such an old relic, why do you think that 71% of central bankers surveyed expect to hold more gold over the next 12 months, right after they have bought more gold in the first half of this year than ever in recorded history? What do you think they know? And what should you know? They know how gold behaves during overnight resets because they take this that has no intrinsic value. It's used in one place, and they reset it against this, which is all intrinsic value because it is used in every single sector of the global economy. And then guess what? This is how gold behaves when they do those overnight revaluations. That still lies ahead, but make no mistake about it, it's coming. And that, I believe, is why they are buying so much gold, to offset the losses that they're already in by holding all that government debt and now at 0% and now ratcheting those interest rates up. But mostly because they want to retain their choices. They want to retain their power and their freedoms. This is the consumer price index, so the purchasing power of the consumer dollar since 2008, since the crisis became apparent to everybody. What was the answer to make it look like things were normal? Your purchasing power loss. And you can see how it's been speeding up. It only goes in one direction. That purchasing power is not coming back. It never does. It never, ever does, because it's been spent away. And oh, by the way, if you received the dollar up here and you tried to save it, look at that loss in purchasing power. They've been robbing you since the day you were born. Are they going to stop now? Why would they? They don't have any choice. Their only option is to repay that debt with dollars or fiat money anywhere in the world that is virtually worthless. It's that nominal confusion. If you had a $20 bill over here, it's still a $20 bill. What you could buy with it then and what you can buy with it today is vastly different. This is also a $20 coin. Did this go down in value? No, it did not. It went up in terms of fiat money. It held your purchasing power intact, which in my opinion is the single most important thing that money is supposed to do. Hold your purchasing power intact. The system is not on your side.
Lynette Zang discussed an approaching crisis while questioning the Fed's rate-cutting effectiveness due to currency concerns and highlighted the current debt bubble. High levels of government debt can create concerns about a country's fiscal sustainability, potentially leading to a loss of confidence in its currency. The U.S. has seen a substantial increase in its national debt over the years, which can contribute to perceptions of decreased value in the dollar. On the other hand, Lynette Zang stated about the Treasury Yield spikes, central banks relying on them for returns, but warns of paying for banks. The 10-year Treasury Yield was last up 11 basis points to 4.793 after climbing to 4.8% earlier on Tuesday. Banks were exposed to an estimated $558.4 billion of unrealized losses in the second quarter on underwater securities, up 8.4% from the quarter before, according to the Federal Deposit Insurance Corporation. Let's get back to the video.
A big crisis, that's what they're counting on here, will justify the next Fed pivot, even though the central bank is coming out and saying no, no, no. So that they're not is higher interest rates for longer. So the question is that you have to ask yourself, all right, let's say that this happens. A big enough crisis, yeah, absolutely, could make the Fed pivot and push interest rates down in an attempt to inspire borrowing and spending. Because if this has absolutely zero value, because during an obvious crisis, there is a flight to perceived safety, hence the treasury bonds. But what's the real safety? Physical gold, physical silver in your possession. That's real safety. The other is simply perceived. So the big talk is really around the treasury yield and how much that has spiked. You can see how quickly it dropped. This is what they're counting on to get you those returns. And they went all the way down to 0.52%. Now they are at 4.69%. Didn't take very long to make that happen. And I believe they went up. I don't know where they closed the day. But that means that all of those banks and anybody that was holding treasury bonds that locked in these rates down here, they are hurting. We saw SVB, we saw the regional banks go out. They want you to think that that problem is fixed. It ain't fixed. It's so much bigger than just those regional banks. And they know that they're doing it. So between the feds are between a rock and a hard place, because by raising rates, they're jeopardizing the economy. And by lowering rates, they're trying to fight inflation. Either way, they're hurting everybody. Either way, we have a crisis brewing. No doubt about that. But just keep in mind, the Fed needs higher rates so they can next crisis. In so doing, they did pop the debt bubble. It is not something I'm waiting for to happen. It's something that's sitting here and happening as we speak. We just can't see it. And I want to point out that the Fed is out of tools. I want you to take a look at where we were, right? Transition away from the gold-backed currency, because we're getting near there again. Look at how quickly interest rates could spike. And every time they raise the rates, which you can see here, and you can see here, you can see it here, you can see it here, it caused a recession. this next one isn't going to be just a standard recession. It's not going to be a soft landing. It's not going to be a no landing. This is going to be big because what they've really done is they have broken a 41-year trend cycle, and those do not go out quietly and without a whimper. They may want you to think so because in that way, then you'll fly to the perceived safety. You'll fly to fiat money assets. This garbage, you'll fly. You shouldn't call it garbage.
Central banks have ramped up their purchases of the yellow metal. Gold buying by central banks hit a first quarter record earlier this year, according to the World Gold Council, with those in Singapore, China, and Turkey among the biggest buyers. Bank shares face selling pressure due to the Fed's indication of prolonged higher rates, while concerns over the US dollar's long-term stability persist due to declining purchasing power and a surging national debt. Do you believe it's time to reconsider the role of gold and its significance in the modern financial world? Share your thoughts in the comment section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more exciting topics. Thank you for watching.